Hello, from LPL Financial, welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is Monday, October 23rd, and this is The Talking Point. And boy, there's a lot to talk about and lots of points that the market has to absorb over this week. Last week, we saw the market selling off as that 10-year Treasury yield moved above 5%. Now, I want to point something out that's logical. Is there that much of a difference between 4.7, 4.8, and 5%? Obviously, there isn't. But you know, if you've been following markets for any time at all, there are certain levels that we cross over, and the market has to, in essence, learn to deal with it. But it can be very difficult, particularly when we're talking about interest rates. And I want to stress that 5% in the history of our country, it was actually kind of normal, around 5%, a little bit more. But remember, it is the speed at which this has happened. We went from negative rates to 1%, mortgages 2%, and suddenly we're seeing everything just change in front of us. And it means also, again, that the cost of capital across the board goes higher, especially if that 5% continues to edge higher. Now, at the same time last week, as you know, there was a really strong presence from Federal Reserve speakers, from the hawks to the doves and Chairman Powell himself. And it was interesting because even the hawks were very careful with their words, that they can be careful, they can watch to see what's happening in the economy before they make a decision on whether or not they need to raise rates. Now, Chairman Powell made it clear that if you have to do it, they're going to do it. Price stability and the return to their level of comfort, which is 2% inflation, that remains absolutely their target. But even from their own reports, their own statements, they're not expecting that to happen until way into the future. But they need to set the path and make sure that inflation doesn't start, galloping ahead just because they go on a pause. But the point is, they're actually declaring that they are willing to wait. They are willing to watch to see how things unfold in the economy and inflation unfolds. So a lot of what we're seeing with that 10-year Treasury yield really is focused on what is going on in Washington, D.C. Are we going to get someone to lead the House? But more important, is anyone going to be strong enough to actually create a committee that goes in and cuts and pares back that deficit? There reaches a point where, the market just says, what are you doing? How much more can we spend? And we know we're spending more in this war effort. We know that we need to rebuild our arsenal, not to mention just, sending what we have in our own arsenal to other countries. But the point here is the spending is out of control, and the Treasury market knows it. And also, there has to be more supply of treasuries being sold, correct, in order to pay for this deficit. And the question is, how much are central banks going to come in and buy? We know that they have been pulling back a bit. And therefore, the others that come into the auctions are going to demand more. They're going to be more price sensitive and concerned about prices than, for example, when central banks come in and buy. So that means that they may require a higher yield in order to come in and a lower price. So all of this is playing out, and it's coming in that area, that 10-year Treasury yield. So the Fed has basically said everything that they could say in many ways to calm markets, that they're prepared to wait it out. They're prepared. And this even includes, by the way, the hawks, the ones that really probably would like to see another rate hike this year. Now, there will be another rate hike this year if, and this is a big if suddenly inflation starts popping up everywhere. And this week we'll get another sense of it, because at the end of the week we will have the Fed's preferred measure of inflation, and that is the personal consumption Expenditures Price Index, the PCE, and we'll see what they have to say, what that report has to say regarding core PCE. This does not include oil. It does not include food. In any case, the other thing that we're going to look at on Friday, and that's the PCE, we're going to look at personal income and personal spending. You don't want to see that spending continue to rise unless personal income is also higher. The last reading of this showed that it was in an equilibrium. Income was up and personal spending was up as well. But also, this week at the end of Friday's data releases at 10 in the morning Eastern, we're going to have the University of Michigan Consumer Sentiment Report. This will be the final report. When they do their reports, they have a early one, and then there's the final one. Here's what we're looking for to make sure that we know that consumer sentiment is down. That's a given. Consumer sentiment is down. We hope that it inches a little bit higher, of course, but what we're really looking for, what the market is looking for, and what the Fed is looking for is, are consumers looking ahead 1 year, a little bit more than 1 year, and saying that they think inflation is going to be higher, which is what we saw last Friday, that they saw on a 1 year basis, they saw inflation climbing higher. This is something that the Fed and any central bank does not want to see. They want to see inflation expectations anchored, meaning they're not climbing higher. So we're going to see on Friday what that report finally, in its final report, has to say. And that will be important, as will be the PCE report. So that's next Friday. Now, before that, we're going to have the home prices, whether or not they've risen. This is from the Case-Shiller report. That will be tomorrow. And then on Wednesday will be new home sales. The expectations actually, right now, consensus estimates is that we have about 682,000 new home sales, which is a climb from the month before September, from August. And we'll see if perhaps people were going out knowing that mortgage rates were climbing. They wanted to get in there quickly. But also, I do want to point out that the builders of new homes, actually, for most of them, the large ones, have their own mortgage processing, mortgage, in essence, company. And they offer actually much more attractive rates than what you would see based on where mortgage rates are. So many do flock to the new home builders in order to enjoy a little bit of a respite on the mortgage rates climbing. And in many of the higher end builders, they get a lot of discounts on some of the upgrades that they want. So we'll see whether or not that holds. And then on Thursday, the GDP report for the third quarter is coming out. Now, this is very interesting because the expectations are that the first read of the third quarter GDP report could be 4.5%. That's solid. That's strong. And of course, for the market is, can this continue with rates climbing higher and so on and so forth. Also, we're going to have pending home sales, and that's expected to be down, but not as bad as it was in the month of August. But we'll also have, and this is important for the market, and it is durable goods orders. And what we're looking for is not just the overall durable goods orders, but core durable goods, because that is a significant look at what companies are spending. And if they're spending money for durable goods, capital expenditures, it's a good sign coming out of corporate America. And then, of course, as I mentioned, the numbers on Friday. But this week also, we are having a very, very wide, deep earnings reports coming out. We're going to have some of the big tech companies coming out. And we saw last week, Tesla, if we call it a tech company, under pressure, the margin pressure. Tesla has to come in and cut prices. But then again, we saw Netflix. Netflix did very well. It was able to raise their prices in some areas and also lots more subscription holders, which is exactly what you look for when you look at Netflix. Also last week, I just want to mention this, Amex, American Express, came out with their report. I follow it very closely, particularly when the market is concerned about where we're headed. In that report, and you notice some of those numbers were very good, the numbers that they gave, but embedded in the report, they showed that spending from small business owners and large companies is coming down. We want to see if that's a one-off. We'll pay attention, obviously, to the next earnings season or any kind of upgrade that they may have during the course of this earnings season and the next one. But that's something that I'm watching, because if companies are saying, hold back spending, that's a significant suggestion that companies are worried about what's going on in the economy. Now, never mind that their cost of capital is also climbing, and they worry that with corporate card expenses that, companies are going to start pulling back how much their workers can use their credit card in terms of business travel and so on. Although I have to say this is an aside. I have been traveling for the last number of weeks, and all that I can say is you can't really tell anymore who's a business traveler. Nobody gets dressed up anymore. So they could be, looking like they're going on a vacation. But the airports are filled. Every single airport I've been in looks as if it's, the Thanksgiving weekend, that long Thanksgiving weekend. It's pretty amazing. But again, I wish I could distinguish between business travelers and just regular folks, but I can just tell you, people are still traveling. So in any event, this week we will hear from the big mega tech names. They will be Alphabet, Meta's reporting this week, and Microsoft. And I'm going to pay particularly close attention to Microsoft, because remember something about the concern when you're concerned about the economy, when you're concerned about where we are headed. Big tech has become, it could change because everyone says, oh, well, they need their long duration. We can't really look at their earnings at this stage because they get paid later on and rates could be higher. But nonetheless, the market is going to be focused on how broad. So for example, with Microsoft, how broad is their earnings platform? And we know that it's deep. They have earnings from all pockets of their business operations and their balance sheets. And we want to hear what their customers are saying. And this is extremely important, again, particularly as the market has been concerned about where we are headed and the effect of higher interest rates. The other thing I do want to point out, too, is that we're going to have more reports this week from Big Oil. And not only that, we've heard another deal announced this week. That is Chevron buying Hess. It's interesting, isn't it? Because this is a play on oil, not green, but oil, and the ability to get oil out at a more expeditious way, a cheaper way. When we deal between ExxonMobil and Pioneer in the Permian Basin, also is about being able to get oil out, that would be shale oil out at a lower price, at lower target, and much easier access. But overall, it is a play on expectations that the so-called peak oil is not that near. So let's keep that in mind, that this build out for green, this build out for electric vehicles, so on, is going to take a longer time than expectations. So we have that deal. Now, in terms of the Middle East, we are looking at gold prices this morning. They are down. They have been very prominent in terms of risk assets. When I'm worried about a conflict, I am going to go out and I am going to buy treasuries, which this is the interesting part, but right, because the treasury yield climbed above 5%. If we had a lot of buying in treasuries, as we did initially as this Middle East conflict began, the treasury yield came down, but we saw the treasury yield obviously climb higher. But gold prices also inched lower, and oil prices have held steady, suggesting that the very, very strong diplomatic efforts, which have expanded exponentially actually working at this point, keeping this conflict contained. Obviously, a lot can happen during the course of the week, but we're talking about what we're looking at now and what we watched during the week. Do we see a huge surge in buying of U.S. Treasuries, which, by the way, would push down the yield? That would be part of that risk-averse spending that you'll see coming in globally, pushing gold prices up, pushing oil prices up. Oil prices have held steady. If there's a belief that this conflict is going to expand and move deep into the region, oil prices are not going to edge higher, inch higher. They're going to surge. We have not seen that at all. So there's a lot for the market at stake this week. And the hope is that we get a House of Representative leader, right? Because the market is looking at, when it looks at that 10-year Treasury, it is okay. It knows what the Fed has in mind, but it is also saying, get our house in order. Start cutting that deficit, because look at all the spending that we are going to have to do now in terms of the global war effort, not to mention rebuilding our own arsenal. So that's it for this week. A lot for the market to absorb. Keep in mind, we're moving towards oversold territory, which means that at some point when the market, if it continues to sell off, we will be oversold. And that lends the underpinning for a relief rally. However, if earnings are strong, if guidance is strong, the House gets a leader, and another one, Middle East states contain. It could be that perhaps the beginning of at least a viable rally. And that's what we look for. We look for follow through in the market. Have a good week. We'll be back next week. Thank you so much. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.